We have an extraordinarily powerful set of panelists here on this. We're going to talk about ESG. We're also going to talk about the pushback that ESG has been getting lately. We're going to talk about the data that ESG requires. And importantly, we're going to talk about the financial returns that are associated or not associated in some cases with ESG. And before we get started with the panelists, I want to ask the audience a question. With your polling, does ESG need to be redefined? We'll be curious about what you think about this as we start to discuss what that could mean. Let's start with you, Megan, because you get to see this from the private markets. And Carlyle, a year ago, announced an initiative to collect data. Now that data set includes 2,000 portfolio companies across more than 200 general partners and limited partners. So why has this been such a focus for you?
Sure, and thank you, Sonali, and thank you to Bloomberg. I'm a proud New Voices graduate, so it's nice to stay in the family. We started working on ESG data exactly because of this question around ESG backlash. One of the biggest criticisms we get is this concept of greenwashing, claiming that you've done something that you don't actually have something to back up. Greenwashing happens when everyone writes their own report card about ESG, and the antidote to that is that we have a common report card. And so we actually worked with CalPERS, Yep, and his team to say, this isn't rocket science. There are so many different frameworks for how you measure ESG data. We get more than 300 ESG data requests every year at Carlyle. Let's sit in a room and agree on how we're going to measure that so we actually get a critical mass of performance-based, quantitative data in a time series to use. So we sat in a room with Blackstone, Apollo, EQT, CVC, a whole host of our peers, and just negotiated. And so we're tracking data across our portfolio in the same way they are, aggregating that into a benchmark, and we just published a report that you covered this morning, actually showing what the data has. Because we can make all the pronouncements we want as an industry about what ESG is or what it isn't. The reality is we need data to show if it works.
And we're going to get to Yep in a second, who does deal with this across all those private equity firms. But Allison, you see this from a public market perspective. You're advising clients on how to navigate this constantly. So what are the biggest ESG concerns that they have? And I should say, you also came from the buy side. You came from Value Act before you started doing this. So you saw this firsthand as an investor yourself.
Exactly. So it's been a long journey, and here we are. And as you say, there's controversy around it. So I would say that a couple of things. First of all, I don't think that this is going away. And in fact, last night I was at dinner with 10 Fortune 100 board members, company board members, and they are all absolutely focused on these points. Because the reason it isn't going away is because the world is changing, and we're seeing this. We're seeing it from a geopolitical perspective. We're seeing it from an investment perspective, a tax perspective, a regulatory perspective. And all of these companies and all of these board members absolutely recognize that their businesses are going to need to transform, but also it's a really good thing, and there's a lot of opportunity around that transformation. I mean, nobody wants to profit from suffering. I actually sit in London. We're dealing with the war in Ukraine, and now instead of talking about energy transition, I mean, we're talking about energy security. We're talking about food security, and these are real issues that companies are absolutely able to address. And investment into those companies ultimately is going to be a really smart thing for investors to be doing.
And long-term issues. We're going to get into the public and private of it all in a second. Yep. A year ago when I talked to your CEO, the CEO of CalPERS, Marcy Frost, about this Carlyle initiative, one of the things she mentioned was this is about data and data collection over a long period of time, right, and proving whether it did contribute to financial returns. Yes. So what are you finding?
Yeah, and I think at the time, as a scaled asset owner, the critical pain point for us was the lack of standardized and transparent data, right, across kind of key ESG factors across our broader portfolio. And look, ESG is a complex topic, but I think we can all agree that coalescing around a very straightforward, quantifiable, comparable, set of metrics reported in a consistent manner is a tremendous improvement from the status quo. Just to give folks a little bit of an analogy, imagine if all private equity-backed portfolio companies reported different profitability metrics. Some decided to solely report on free cash flow, others EBITDA, others net income. How difficult would it be to kind of truly understand the progress, the operating progress of funds over time? And kind of to the point earlier on greenwashing, look, if a private equity manager had 10 companies one reported a 4 times return, and the other 9 were full write-offs. What's happening today is that there's a glossy annual report that goes out celebrating that 4x return. It's not intellectually kind of consistent and honest around what the total progress being made is. And so I do think what this data collection now empowers us to do is this. So when you have 2 GPs, general partner A and general partner B, one generated a 21% return and a 2.1 times, but while doing so, they reduced GHG emissions by 50%, increased renewable resources by 20%, increased corporate board diversity, added jobs, ... And there's another one that generated the 2.3 times return, a 23% return, but at the same time, just kind of the really deteriorating metrics across these areas. And so you understand which strategy is riskier long term. And so I do think this is what kind of the EDCI really empowers both asset owners and general partners to do.
Now, when I looked up at the poll as it was populating, it was pretty overwhelming of a yes for the redefinition. ESG is broad. A lot of people don't even agree with a lot of the facts that are being posed on ESG theses. So what are you thinking when you look at your clients, their needs, and how they would like to tackle the problem?
Yeah, it's one of my most favorite and least favorite questions. People love to say, like, I don't believe in ESG or I believe in ESG. Like, ESG is not a religion. You don't believe in it. It's an investment methodology. And people apply it in a variety of different ways. There are excellent ESG integrated managers and there are really poor ones. And so somehow we get stuck in this conversation of ESG is a monolith. And it's also something that you can believe in as something that is inherently going to lead to outperformance or inherently going to lead to underperformance. And that's just not the reality. And it's a little bit like saying, does venture capital inherently outperform or does it underperform? There are a variety of managers who have a variety of skill in prosecuting that. And so, let's take one example, climate change and the energy transition. You don't need to believe in climate change, even though it is unimpeachable science that it's happening, to think that if you're investing in a long-hold infrastructure asset in coastal real estate, that you might want to be thoughtful about the insurability of that asset, the climate resilience, and how you think about its situation vis-a-vis floodplains. That has nothing to do with belief. That has to do with long-term risk-adjusted returns. And so I think as an industry, we have conflated 2 different topics that can sometimes overlap, but they are different. And that's it. Individual investors can take individual moral, political, personal views that they want in their portfolio. You can say, I don't want to own gambling companies. You can say, I also don't want to own companies that start with the letter B. That's fine, and that's your prerogative. That's fundamentally different than taking a long-term view on what's driving risk and return in a nuanced way across assets. And so I think the ESG criticism is very warranted, but it's got to be correct about what are we actually criticizing. We need to focus in on how managers integrate this into their thesis, how they effectuate it, how they're tracking it, and does that lead to outperformance?
So if you had the chance to redefine ESG, Allison, how would you give it a new name?
Okay, there's not one name because that's the problem with ESG itself. I think it might be a lot better if managers and products, investment products, were just clearer in how they labeled themselves. For example, very much to Megan's point, labeling yourself a climate risk adjusted fund. Okay, then you know what you're buying. The label's on the tin. An impact fund, impact in order to solve social or environmental problems. A fund that's about energy transition. I think that, we are talking here in the Invest Conference, so we're talking about investment strategies. I think if people were a lot clearer, meaning fund managers, GPs were a lot clearer, I think that would really enable LPs, sophisticated or very unsophisticated, people who are buying ETFs, people who are buying mutual funds, to be very clear on what it is that they're buying and what they believe in and what they don't believe in.
Yep, when you're giving advice, say, to managers across the industry, how do you look at it? What do you prioritize? And what are the types of investments you're more likely to make that are ESG friendly?
Yeah, and again, just speaking kind of from the private equity vantage point, the first kind of comment that I do tell our GPs is recognize the power, the privilege, and the responsibility you have as truly a change catalyst, to driving and accelerating returns while also positively impacting society, right? I do think, just to give one analogy, I do think there was a time when digital strategy was met with deep skepticism by CEOs and management teams across the board. Its power to accelerate revenue, to dramatically cut costs, and also improve the productivity of workforce. And so I think we're early days on the development of kind of the full ESG value creation toolkits, but I think there's been very meaningful kind of progress made on some of these areas. And so I think one of the advice I tell GPs is, look, you have a superior ownership model coupled with a long-term orientation. Use those things to look at different types of ESG levers that can really transform your business. And I'm not here to tell you which ones to focus on, but this is directly correlated to kind of equity value creation outcomes. And so there is that piece. And obviously, I also tell them to join the EDCI initiative, because in many ways, I mean, it is difficult to truly understand your progress across these key ESG factors if you don't know what the rest of the industry is doing, right? What is the benefit of understanding that you reduce, again, GHG emissions or added an X number of jobs over a certain period if you don't know what the rest of the industry is doing?
So speaking of jobs, one of the findings from the report that you both are involved, BCG compiles all the data, and what they found is areas that private markets have lagged are areas like board diversity, but they have gained in areas like energy. And so I'm kind of curious here, from your perspective, where does the private market surpass the public market the most, and why?
Yeah, and I'll start maybe your question, Allison, about what should we rename this to. I think ESG done well is another lens for alpha in the 21st century. It is not the only lens, but is one if you use it well and use it to uncover insights that haven't been priced into the market yet. And I think what we saw in that data, where we actually had comparable performance-based data, was that what is actually happening flies in the face of the public narrative. And so one example is private equity, when maligned, is frequently characterized as an industry that comes in and strips out jobs as a way to make returns. That's not actually the reality in the 21st century, as you think about your social license to operate, as you think about economic growth. And so the data from 2,000 private companies across more than 100 GPs found that privately held companies create jobs at 2 to 3 times the rate of publicly held companies. There are definitely areas where private equity lags. Board diversity is a great example, but it also showed preliminary data that board diversity increases far faster under private equity ownership than public ownership. And I think we've talked a lot about that, but it gets this idea of concentrated ownership, longer time horizon, and the ability to really affect change such that you can exit a company to higher value. And in the 21st century, companies are worth more when they excel on material, environmental, and social dimensions.
So Allison, we were talking about private market ownership. There's a lot of criticism out there about, ESG being difficult for a company in the public markets that is subject to shorter-term returns for shareholders. Is that true from your perspective, especially, from Value Act to now, right? I mean, governance was one of the early tenets of ESG.
Absolutely, and I think governance, we have to really separate out from what most people think about with ESG. To answer your question, the public markets it's hard for corporates. It's very hard for corporates because there's so many different dimensions that they're dealing with. And the SEC, as we all know, we're waiting with bated breath to see where the SEC is going to take us with the climate disclosures, which are a very big deal. So we'll see what's going to happen there. And if it's a lot of disclosure, and we were just talking about how important data is. It's incredibly important, and there's going to be a lot of data associated with that. So one thing I do want to mention, though, is public companies are dealing with. It's also debt, and we're talking a lot about equity, and we're talking about private equity, but there's also private and public companies, and their lifeblood is debt. I mean, that's how they're able to run their business. The public market investor on the equity side is obviously incredibly important and can basically hire and fire the board, so they have a big voice there, but the day-to-day operation of a company, debt is really important. And we're definitely seeing much more of the debt markets turning on to this, and with interest rates rising, if companies are able to connect and genuinely connect their goals that they're trying to achieve with, exactly to Megan's point, being a 21st century transition company that's successful, they're going to need debt to get there. And if they can get a difference of 25 basis points or 50 basis points when interest rates are rising, that's something that really can connect the public markets into making these behavioral changes that are going to drive what will hopefully be more profitable companies going forward.
Navigating some challenges here. Let's take one very large, very big example that happened this year with Disney. Disney versus Ron DeSantis. It wasn't just the governor versus the company. It was also another investor that had called out Disney, one for financial performance and with certain goals, we know that of Third Point, but another, Strive Capital, that spoke to Disney about putting political and social above the customer's needs. And so I'm wondering, how often are you seeing that among big publicly traded companies? Is this happening on a level that's just not playing out as much in such a public sphere?
Well, this is a whole brave new world. We saw it, absolutely with Disney. We're seeing it with a lot of companies. A lot of this debate is opening up, right? I mean, there was just a lot of approach in one direction, and all of a sudden you're seeing, we'll just call it pushback for lack of anything else. And I think raising a question, which is really relevant, is what is the value to a company and in terms of where it is going to come out in its policies and its public statements. And this goes across to that, it goes across to the abortion debate. There's a lot of different issues here and how companies are going to be dealing with it. And it's really important, more and more, for companies to make sure that they're articulating and that they're clearly connecting their thesis of their business strategy to what they're doing. Because you leave yourself open potentially for criticism when there becomes an unclear disconnect between the business strategy and the policies that may come out that are not as clearly connected to business strategy. So I think I'm kind of going around your question, but if there was anything that as a CEO or a board I would think about as they want to wade into what could be looked at as the political sphere, an area that CEOs and boards, frankly, have not had to do before, and you don't learn at Harvard Business School, and is really, really difficult, that sort of touchstone or North Star would be making sure that you're very clearly connecting your business strategy to what you're doing.
And part of that was just to highlight also that even among a company's own investor base, there's disagreement on what that one company should do. That also plays out in the private markets. It's interesting. You started this with Carlyle, but I've been doing a lot of digging for this panel, and in a conversation with a rival pension scheme. And this is happening for probably a lot of people here. They don't share, not every state shares the same views on ESG, especially when it comes to the social issues. Yep. So when you're a GP, how do you deal with navigating across state lines and frankly international lines at that rate?
Yeah, so I think at the end of the day, we don't need to call it ESG. And I think that actually would help a lot. And so, people, again, think of it as very much of a binary. You're a green company or you're a brown company. You care about social issues, you don't care about social issues. And I think the reality is, where are these factors associated with long-term performance? You might think that diversity is just a social issue and companies shouldn't comment on it and that, it's not something for business performance. It's not connected. We have 300 portfolio companies-ish on any given day at Carlyle. The data in our portfolio is unimpeachable. Our companies that have more diverse boards have higher earnings growth by a significant margin. Correlation, causation, the data is there. And so if you can connect those factors to why more diverse teams make better decisions, lead teams in a different route, that fundamentally has to be where the conversation begins and ends, because we all have different views about social issues, about the way we want the world to be. But I think we need to get out of this idea of good versus bad, green versus brown, et cetera. And the energy transition is a great example. You mentioned this, Allison, of, in the lead up to COVID and in lead up to all the chaos we've seen in energy markets this past year, huge focus on climate change. Some people interpreted that as renewable energy or bust. And what we're seeing is the answer is we need all of the above. And frankly, the highest decarbonization potential is in the most carbon-intensive businesses.
So a bit of a toss-up question for the team here, because each of you have focused in on financial performance, but a common complaint that you hear from investors and companies is that they feel at the whims of lawmakers and all of the forces of social change. So when does it start to matter for financial performance? When can it be unignorable, given that at the end of the day, lawmakers are a constituent?
Well, you hear different things from different lawmakers, and it makes it incredibly difficult. And we're seeing that more and more now. And it's often pulling into social issues. Again, I got to go back to sort of more this global perspective, that you are seeing different currents in Europe than you are seeing in the US. In Europe, there's those sort of like the government and the political elements of it tend to be tied directly to a lot of these same policies. So it is a little bit different, and which is why I did bring up the war, because it really focused a lot of people on these issues of security. But it's incredibly difficult to now. You can't please everybody all of the time, and we all know that, which makes it really, really hard. So I would, again, go back to that touchstone is the business strategy. And if your business strategy is very tightly understood and very tightly articulated, and the company is all striving in that direction, my opinion is it may be better to ignore the noise and just kind of stick with the path.
I also think we kept waiting for action on a price on carbon, because that would then dictate corporate behavior. We haven't gotten that in a global way. But what we're seeing is actually corporate pressures are pushing our portfolio companies way faster. We call it the net zero domino effect. 90% of the world's GDP is now covered by net zero commitments. And what that means is large corporates like Walmart, Target, et cetera, as they make these commitments to reduce their carbon emissions, they push that up and down their supply chain. So if you're thinking about selling into a municipal customer, to a corporate customer, all of these different constituents, you might be miles away from the energy supply chain, but if you don't know your carbon emissions now and you're not slightly better than peers, you don't win that piece of business. So I think we focused on the kind of regulatory legal side for a long time, but I think the competitive pressures are here today, and that's actually changing business decision.
Yeah, and I, the only thing I would add is, like, as industries transition towards more sustainable and inclusive business models, it is, again, private equity's job to just figure out, how do you not, see where the puck is going, right? And how do you future-proof your businesses such that if there are, regulatory action and change, that you don't, get caught empty-handed, whereas all your competitors are just very well prepared for some of those, transitions. And I do think, at the end of the day, the data that is being collected through EVCI is early, but I think, overall, if you see kind of private equity owners catalyze change, where you're, kind of increasing employee engagement, reducing workplace injuries, adding jobs, I do think there's just a lot of positive tailwinds, to the outcomes of these deals. And so I think, just in terms of correlation and causation, we're still early in being able to really solidly make those statements. But again, I think in the same way, digital strategy, softwares, application software, kind of services and infrastructures, transformative power to really propel and accelerate our global industry. I think we're early days, but I am hopeful that as we amass more data, that will become much more clear and less of a guess. Right?
Early
I think
days.
you may have just hit on something, calling it sustainable, future-proofed investing instead of ESG.
Yeah, well, that was going to be my final words here from each of you, because if this is a nascent industry and it's reaching its adolescent phase, if that's fair enough, what is kind of the most interesting and next vantage point that you are pushing towards?
I like the concept of dynamic materiality. As we get to know these topics and they get better understood, they get priced in. But there always is something coming around the corner. We saw that with the Me Too movement a few years ago. That wasn't historically a deep part of diligence for new companies. That has become a standard part of how we think about management teams and culture. I think we're seeing that with climate right now as we understand what to price in, how to value that. But there are issues coming down the pike at us, from water scarcity to biodiversity, et cetera, and they're really going to impact company performance. So I love that idea of this is constantly evolving. And as we understand things, we can manage them, but there's always something new coming.
How do you move the needle forward?
I think the search for alpha is incredibly competitive, and it's hard. And so you need to win on every angle, right? Yeah. Just think about just kind of, many of you guys are leaders of large organizations. And so in terms of even attracting kind of the next generation of top decile talent, just having the proper culture, the right mission, the toolkits to really attract and retain these individuals is critical to winning the next decade. And how do you do that without, kind of having these things in mind, as you kind of propel your companies forward? And so
I love that idea of dynamic materiality, Megan. I think that's brilliant. And I'm so glad that you brought up other issues beside climate, and also the biodiversity and these other issues. And it's so important. And therefore, companies that are going to be sustainable and future-proofed and very, very profitable in all of that is going to be the future.